To the US, where tomorrow the Senate Banking Committee votes on Janet Yellen's nomination as the first female Federal Reserve chairman. Yet markets seem in the dark about the Fed's strategy going forward. Well, financial expert John Mauldin is a pioneering online commentator through his company Mauldin Economics, and his books have been on the New York bestseller list 4 times. His latest, Code Red, out this month, is on central bank policies and currency wars, and I spoke to him from Dallas earlier today. John Mauldin, welcome to the programme.
Good to be here, Kiki.
Well, we're all focused on tapering and when money printing in the US may end. But you don't see this as the main preoccupation of the Federal Reserve at the moment. Why not?
Well, if you look at the recent papers that 2 lead Federal Reserve economists wrote with a whole group, plus the other speeches we're getting, the papers from Jackson Hole over the last few months, for all intents and purposes, the Fed has moved on from tapering. They know they're going to taper. They know they're going to have to pull QE off. And they're beginning to think of, what do we do after that? How do we convince the markets that the world isn't coming to an end? And what the 2, really lead staff economists for the Fed have suggested is that they commit to what they call much longer term forward guidance. We're talking 0 interest rates out until 2017, a 4-year forward guidance, if you will, that says, listen, we're going to have easy money, so don't panic. Don't think that just because we're tapering, as soon as the tapering's done, we're going to start raising rates.
This commitment to 0 interest rates for a period much longer than traditional economic thinking would have, I wonder what's underpinning that. There seems to be a focus very much on the demand side, on the consumer.
Central banks all over the world, not just the US, but Europe, Japan, Australia, are captured by a philosophy called Keynesianism. And they believe that it's consumption that drives, demand, that drives the economy. If you're more like I am, or Hayek or others, you would be suggesting that it's income, that we should be focused on producing income, but they want to focus on consumption. So one of the ways you do that is to bring rates down, allow people to borrow more. You encourage people to move out the risk curve, to invest in products, because they can't get a return on their savings, and they want the drive is simply to push consumerism as much as possible. I think that's counterproductive. I think what that does is when you reduce interest rates, you make people say, gee, I need to save more to be able to have enough for retirement. You lower their consumption of the people that are retired, that they're making less on their money, so they have less to spend. But that's not the way that that theory operates.
You mentioned savings there. What are the other, perhaps unintended consequences of long-term 0 interest rates?
One of my biggest concerns is that, in fact, it's a 2-part concern. Number one, this would make the dollar a carry trade currency. If you lock in low rates for a long period of time in what's otherwise going to be a relatively strong currency, which I think the dollar will be, then you're just inviting a carry trade. You're going to, especially the global reserve currency, you're going to hedge funds, pension funds, anybody that's larger investors, and you say, you're going to get to borrow money for almost free for 4 years and turn around and invest it and make the difference. So if you can borrow money at 3% and you can sell it, put it in an investment you think is going to make 6 or 7, and you lever that up a few times, all of a sudden you're making 12, 13% on a low interest rate environment. That sounds really good. Well, what happens is people start chasing those really good opportunities because they're going further out. It's not just we get a carry trade for a year or 2 years. Now we're talking 4 years. So it reduces yields even more to the average investor. It makes it more difficult for people to get a return on their money. And the second thing that it does is it creates more of an opportunity for financial transactions rather than productive transactions. It becomes cheaper to buy your competitor rather than increasing your plant capacity to compete with him, thereby buying more stuff, hiring more people. So the financial transaction, in essence, drives out the productive transaction. If you're a businessman, it makes perfect sense. But that's not what we really want in an economy. In an economy, we want people going out and taking risk and competing, not buying their competitors.
Just on a stronger US dollar, is this likely to lead to more currency wars?
We're getting ready to enter a period of currency wars. Japan launched the first missile this last spring, and my co-author of Endgame and I wrote a book that just is out this month called Code Red, and it's basically about central bank policies and what we feel is going to be the problem of the latter half of the decade, which is currency wars. Country after country is going to have to try to figure out how to compete with each other in a globalized global trade world, and one of the ways they're going to want to do it is to keep their currency low. The problem is everybody can't keep their currency low at the same time. Everybody can't be an exporter. Somebody's got to buy. Driving your currency down beggars your own country, and it beggars your neighbors as well. It's self-defeating. In the long term, it doesn't help. It all washes out. But that's hard to tell a businessman. That's hard to tell a politician. They make these assumptions. They try to play to their own home team, and they make policies that aren't good for the world in general, and really aren't good for their own people in the short term, and the long term.
Now, John, we hear so much about bubbles. What assets around the world worry you the most?
The one thing they have to begin to look at is to recognize we're going to see more volatility, more ups and downs. So you do have to number one, first and foremost, invest in things that central banks can't print. If it's tied to or can be tied to central bank printing, it's going to be very volatile and could be questionable. You don't want to chase bubbles. If you see a bubble building, you let it happen, and then you realize that cash is an option. And after the bubble breaks, there's generally very, very good opportunities to go in and invest for the long term. Right now, there's many countries that have had bubbles. They've burst. And you can go in and you buy stocks at very low valuations. You're really looking for value opportunities rather than trying to chase a momentum market. It's all about figuring out how to get income on your return, on your capital, on your investment, and recognize that sometimes you might have to be a little bit less traditional. You have to be, I'm talking to Australians, so you guys are willing to go global. But in the U.S., sometimes we get so focused on just the U.S., we don't realize there's opportunities all over the world.
Now, in your book, Code Red, how do you advise investors to get through the current period?
Frankly, I look at the valuations of real estate in Australia or Canada, and I'm going, wow, that's pretty high. But I said that 2 years ago. And they continue to go up. I'm getting worried about the U.S. stock markets. We seem to be driving a momentum model, and at some point QE will have to happen, the tapering. So I would expect that to ease off a bit. I'm not as huge a fan of commodities in terms of an index of a broad global basis there, but I don't think there's a bubble by any means. What we're seeing is there are countries where that money is being injected. I would look at as an opportunity for a short of the Japanese yen. I think the Japanese yen is going to continue to go down against the U.S. dollar, against the Aussie dollar, and they're offering us an opportunity, I think, to make a significant trade over the next 4, 5, 6 years. They're very, very committed to monetizing their debt. We should take advantage of it.
There's even talk of QE infinity, but I think you believe that Janet Yellen is likely to move on tapering in the short term. I'm wondering how much she would be worried about what is left in the tank for the Federal Reserve if there is a crisis.
It's partially that they need to figure out how to stop back and reload, but partially you're seeing a great deal of research come out now that shows that quantitative easing is not having an effect. And that's what the effect of the Federal Reserve papers were. They're saying forward guidance is far more important. That's what we saw at the major papers that were presented at Jackson Hole, which is the major central bank confab from around the world. They recognize also that there's a limit to how much a central bank balance sheet can be. And you don't want to find the limit by going too far. So it's better to begin to say, it's not working all that well. Let's move to forward guidance. Let's commit to low rates and begin to taper. That seems to be the direction they're going.
You seem quite sceptical about what this policy could do for productivity. But of course, we've also got structural problems with the US budget deficit. How will this be addressed?
I wish I could give you a firm answer. I hope that, people look and begin to realize how truly serious the situation is and recognize we have to have some compromises if we're going to get something done. Right now, we don't seem to have parties willing to compromise, which means that if we keep putting the problem off, we'll have a crisis. Winston Churchill said that you can always count on the Americans to do the right thing after they've tried everything else. So I hope we don't get to that situation, but it may be. We may have to have a crisis. We may have to have the bond market begin to rebel on us at the long end of the curve, even with the Fed trying to hold rates down, and simply forcing Congress and the White House to deal with the deficit. Quite frankly, I think once the United States deals with its deficit, that as a country we'll be in relatively good economic shape. We've been very lucky to find so much oil and gas in the United States. We're going to reduce our imports and we're going to be exporting more of that natural gas and chemicals. Our trade deficit could actually disappear in 10 years. What a concept. The world is not prepared for that. That would make the U.S. dollar remarkably strong. But in Australia, you're having the same potential boom down in your southern area where you're finding massive amounts of natural gas. And so this is a boom around the world that I think bodes well for the world. It's going to remove our dependence on Middle Eastern energy that is kind of dicey and put it, at least in the hands of Australia and the United States, back in more domestic friendly hands.
John Mauldin, we've been looking forward to having you on the show. Thank you so much for joining us.
It's good, and let's do it again soon.